Hi, everyone. It's Rick Bensignor, and welcome to this week's In the Know Trader Show. So I'm doing this one remotely from sunny southern Florida. I've been away for a few days on a trip already. First, having left New York and visited Houston, where my son is a intern this summer at NASA at the Johnson Space Center. So just by chance, when I made plans to see him, I didn't know back a month ago, or actually 2 months ago, when I booked the flights and stuff, that this past weekend was also the 50th anniversary of the Walk on the Moon. So lots of great celebrations down there, and I had a wonderful time. And now I'm in Florida for several days, meeting a couple of clients, as well as hanging out with a friend who's one of my dearest friends for over 40 years. So having a great time and doing the podcast from down here. So let's talk about what we're going to look at this week and go through in our half hour. First things first is kind of getting ready for next week's Fed meeting. So we'll talk about that. We'll look at the sector performances of the S&P in year-to-date or so and what the S&P is doing. And then this week I thought, instead of going in a particular sector, I figured let's take a look at the biggest names out there in the S&P, the top dozen names. Obviously, these are very widely held by many, many people. And obviously there's a heck of a lot of tech in there, but we'll look at these dozen names or so. And we'll get through as many of them as we can, as long as we have time for them. So let's first just talk about getting ready for next week's Fed meeting. And what do I mean by getting ready? So, of course, the market prices their expectation of what the Fed's going to do. And I would say at this point, the market is probably pricing in a 25 basis point cut. That's down from a 50 basis point cut probably about a week and a half ago. But then some of the Fed governors were in doing public appearances, made some comments that the Fed tried to make clear weren't necessarily what the intention of the speech was. But what the marketplace has turned and accepted is that there'll probably be a cut. It'll likely be a small cut and not the 50 basis points that originally the market was looking for. That's why the market came off last week. I think it was 4 out of 5 days the S&P was down. So part of it is, the market has already built in expectations. But when I say let's getting ready for the next Fed meeting and the results of it, what I'm also implying here is that you as an investor should have a game plan in mind of what you're going to do depending upon different outcomes that can happen when the FOMC releases this rate information next week. Meaning that if the market gets a spike higher and whatever the rate information is better than the market had expected, if the market moves up, are you looking to buy into that move? Because if it moves up, it's going to happen quickly. So you need to be prepared to act quickly. At the same time, if the market moves up, are you going to use that same opportunity to lighten up long exposure? And let's say if the market sells off rather quickly because it's a disappointment what the Fed did, do you have a game plan in mind? And my suggestion is you do, that if the market starts coming off hard, same thing. Are you looking to buy into that dip or are you looking to lighten up? So I think what you want to do is have a game plan in mind, not just wait to see what happens and then figure out what to do. You should have a plan in mind going into the meeting such that if the market rallies, you know what you're doing, and if the market comes off, you know what you're doing, rather than trying to first wait for all the reaction and then decide. Because let's just say, for example, the market comes off decently and it's a disappointment. Whatever the Fed does is a disappointment to investors. And within a day or two, the S&P is down 50 points. Let's just say that as an example, a couple of percent. If you wait to then, if let's say you were going to sell into the weakness and then you wait further, then you may wait for a bounce saying, gee, I missed 2% of a decline. Let's wait for a bounce to sell into. Well, maybe the bounce never comes and it keeps going down. That's why I'm saying be prepared beforehand. When the marketplace is waiting for a big event, in this case, it's the rate announcement by the FOMC, you want to have a game plan in place beforehand. So that's either sell stops underneath the market, that's buy orders underneath the market, it could be sell orders above the market, it could even be buy stops above the market, just depending upon if you want to buy further strength or sell into strength. Have a game plan set in your mind with orders to play that game plan so that you don't let emotions get in the way when the markets start moving quickly. So that's my 2 cents of what to do, especially considering the market's near all-time highs. And you know that certainly a disappointment could knock the market down very quickly at this point. And we'll talk about when we look at the S&P. We'll talk about some of the levels to look at that I think at this point are key levels. But I think anytime the marketplace is waiting for a big number, and remember too, it's summertime. A lot of people are on vacation. Markets tend to get a little less liquid in the summer, which means that moves can be exacerbated in either direction. I like to have a game plan going into a number that could easily change the perception of what the market's going to do. Okay, let's look at sector performance. So here we go. So here's the S&P. Because I'm traveling, I don't happen to have last week. Usually we try to do a side-by-side comparison of what it looks like now versus last week. But through yesterday's close, here's the StockCharts performance chart of the 11 S&P sectors, and this is set versus the S&P itself. So if you're above the zero line is how much that particular sector is outperforming year to date. The 1, 2, 3, 4, the 5 sectors that are underperforming, again, these are all relative to the S&P. StockCharts does a very good job here of displaying this relative to the benchmark, and they have lots of pre-formatted groups you can look at. Here I happen to be looking at the S&P versus the 11 macro sectors. So look, technology continues to outperform. It's the best name of the year. Big change is that real estate is now only outperforming. This is all the way on the far right-hand side by 4.10%. That is well down compared to what it had been recently. Consumer discretionary, all the way on the far left side, has now actually slightly gone ahead of real estate to be the second best performing group. And we noted this a few weeks ago, that we saw a difference that discretionary started getting a bid too. And then you've got lots in the middle, which are kind of insignificant above or beneath the S&P. And of course, the two worst ones continue to be energy and healthcare. Looks like healthcare has slid back into being the worst performer, down about 10.6%, underperforming the S&P, with energy 9.27. And those almost weekly go back and forth as far as which one's the lousiest performer there. So that's a quick look of that. And now let's take a look at the S&P itself. And you can see there are a few things here of importance. One is about a little over a week ago, the aggressive sequential 13 signal was showing upside exhaustion. And for the last week, a little over a week and a half or so, we've kind of mostly gone sideways, which is what that indicator gives us a sense of, is when a market is exhausting the current trend that it's in. And this is a daily chart. By the way, if I flip to a weekly, you'll notice the weekly chart also has upside exhaustion. And that's what's getting me much more defensive here, is that we have multiple time frames giving us the same type signals. Now, the calculation is the same, but the time frame is different. And when you get two time frames lining up, whether it's daily and weekly, daily and monthly, monthly and weekly, it just increases the odds that you're potentially running out of steam. And it's also typically a signal that would suggest that first, adding new longs into what has been an uptrend for months and months comes with much higher risk. So in our weekly in the know trader, report that subscribers that subscribers get. You know, we've been saying over the last couple of weeks, we're not really adding equity longs. We're finding other ETFs to trade that are not directly tied to the stock market, such that then I don't have to worry about buying into strength, which is really what this signal is a caution of. It's pretty much telling you when not to be a buyer in an uptrend or when not to be a seller in a downtrend. So right now it's telling us don't really be, the risk of first putting on new long exposure is quite high up here. So I was talking about a game plan going into the, we're back here on the daily chart, a game plan going into this number. And what I'm looking at now, and I've told both in-the-know trader clients as well as Bensignor investment strategy clients, which is our institutional consulting arm, that 2900, basically 2901, is my line in the sand now. And basically here, I'll kind of highlight it here. So this level here that we've got highlighted is the daily propulsion level that turns bearish. So if we properly breach, let's just call it 2901 in round numbers, then this opens the door for a greater decline. And the reason I'm willing to use this number too is it's beneath what had been the previous double top in the S&P, which was near, you know, both sides of, let's say, 2950. So the first high last October, I think, was 2941. Then we got to about 2951 or 55. So I'm willing to see the S&P come back underneath what was the prior double top. And if we do come underneath there, right away, you're going to have bears come out of the woodwork saying, you know, we've broken through what had been the double top. That's very bearish. It may be, but I'm willing to give almost a 2% leeway there before really getting into sell mode. But under 2900, my game plan is to really hedge a substantial amount of long exposure that a portfolio manager or yourselves would have on their books. As far as upside targets, we've talked about 3032 for quite some time. You can see it highlighted here. That is the propulsion exhaustion level from this signal here at 2880. So properly breaking through 2880 said we would get to 3032. We haven't gotten there yet. The high of the move is, looks like 3018. So there's still, you know, a little bit of room on the upside before I hit that target, as well as measuring off of the low in June, another DeMark model called trend factors, which are market moves of 5.56% increments, by chance happens to be at the same level as the propulsion exhaustion level. They're unrelated, totally unrelated, yet they're coming up in the same place. Therefore, that to me makes this area rather significant. The other thing that I'm looking at is if I flip back to the weekly, we've got like 3050 or so as being the stop out level to this 13. So anywhere from 30, roughly 3030 to 3050 or so, I think is a place that's a key inflection point for the market. I don't mind taking a little off from there if I'm long, so I would kind of use strength to sell into at this point. But I'm not going that short. I'm just, we'll take off some long exposure into that 30-point range or so. So that's my look on the S&P. And now let's get into some of the, as I said, like the top 10 or 12 names that we see market cap-wise in the market. So we're going to start off with what's number one now, Amazon. We go to all-time highs. Back last year, 2050 is the all-time high. 2 weeks ago, we got to 2036, so we're certainly very close to all-time highs. You'll notice that there was a propulsion, this teal line here that's bright teal colored, had a propulsion exhaustion level at 2000, so we've already kind of hit that and pulled back a bit. But also when I look at the counts towards the countdown portion, we're only on a 7 on standard sequential and a 9 count on aggressive sequential. This is on the weekly chart. So they still would suggest that there's room to go. And ultimately, the next target up could be as high as 23.29, all the way up here. So if I'm long the name, which I am in my own account too, I've been long Amazon, you know, when and if this makes new all-time highs and goes another 10% or so, I'll probably be taking off something near 23.25. On the downside, the weekly bearish propulsion level right now is at 1850. And so this is kind of a key level to me. Again, if we properly break this with a qualified and confirmed close underneath there, then it says we're going down here to, by chance, where the top of the cloud is now. That'll move a little higher over the next several months, but something in the 1665-ish area would be the downside target. So right now, the real key, you know, place to be looking at is 1850. It's well above the highs for the year. I'm sorry, well above the lows for the year, which was down here in May when we got to 1672. So it's not like you're showing a lot of weakness, but if we stall here and properly break beneath, that's my game plan. Let's take a look at Apple. So a couple of things of note here on Apple. Easy to see that we've got both sequential and aggressive sequential 13 signals here within, let's say, the past month or so. Both happen to show up. So tough for me to be a buyer of Apple here. Now, this is also a name that I happen to be long from multiple prices over time. And I mention that because I always like to make sure you know if I'm talking about a name I own, I disclose it, but I do this very, very objectively. Doesn't matter if I own it or not. I'm never going to tell you to be more bullish or more bearish than I actually am based upon the models we use. So, so first things first is it's a kind of a tough buy for me here. Secondly, just looking without that piece of information is that this week we hit the teal colored level at 206.92, which was where somewhere tucked in here. I don't even see it. Here we go. This little greenish triangle here, breaking above this correctly at 188 and change, said we'd go up here. If we get through this correctly, which depending upon how we open next week, could suggest that we go as high as 243 as part of a bigger leg higher. And, you know, that's a level also I potentially look to lighten up, as well as 231 when we get there, which is the stop out level from these 13s. So some different levels above where it can potentially lighten. Interesting to note, too, is that last fall, going into early winter, when we had the whole, you know, bottom of the move going into the Christmas bottom, not only did this bottom on a weekly setup 9 count, just as it had pretty much topped beforehand, but the lagging line on the cloud chart, which is this blue line, is nothing more than current price pushed back in time 26 bars. In this case, it's 26 weeks because we're looking at a weekly chart. Notice that even though price broke through the cloud, which is already a major warning signal of a potential change in trend, the lagging line never broke through its cloud based on a Friday close. So this close here was this close right here. And between the 9 count and the close being right against the bottom of the cloud, to me, that's a very low risk buy signal, because the setup 9 count often gives you trend exhaustion, and the fact that the cloud model, which has nothing to do with mark models, gave you a very low risk buy. Combined, to me, that's a place that if you're wrong, you lose a few bucks on the stock. If you're right, you literally have the bottom. And in this case, it was the bottom. Notice too, on the sell-off here in June, again, price broke beneath the cloud, the lagging line kind of touched the top of its cloud and turned around and went up. So the cloud model has been very helpful in Apple in just giving you a sense that the long-term bull market is still intact. Now on a weekly basis, back in 2016, when the market sold off the cloud model, the lagging line broke beneath its cloud and at least gave you some signal that things could be in trouble, and market rallied back to the cloud and at least then tested those lows down at 90 bucks before turning around and eventually breaking out to the upside, as did the lagging line, and then you went back into bull market. So the cloud model, again, totally unrelated model, has nothing to do with the mark models, can be very helpful here. Key level on the downside for Apple, our Friday closes under 192.44. Again, if it's done with a qualified and confirmed close underneath, it would at least suggest a retest of that 169 level. So that's Apple. What do we have here? Microsoft. Let's go right now. The #1 market cap name. So this long-term bull. Look at this over time. In fact, this is a much stronger name. You can go back. The last time both price action and the lagging line in blue were underneath its clouds were 2011. So this has been one of the strongest bull moves over time. You didn't have to know a lot about Microsoft as a company if you're technically inclined as an investor and you know how to use cloud charts. This could have gotten you long 8 years ago and would still be in the name now. As far as looking at what we've got here now, again, kind of a weekly 13 suggesting some pause. An 11 count on standard and sequential, so we still may go a little higher. Upside target of 156 and change, certainly a place that you could consider reducing some exposure. On the downside now, fairly tight stop for certainly traders. Friday closes under 135. That's qualified and confirmed. Can't happen this week, but next week, if we close up this week relative to last week, and then next week closes down under 135, and the following Monday opens lower, it at least targets 129 to 118. So you can see here too that depending upon what the Fed does, if the market doesn't take it well, Microsoft's a name that could easily go from current levels down and lose 20 bucks down to 118 if you get kind of a flush in the market. So again, important levels to look at. Facebook. Count-wise, Facebook's not near exhaustion. Now, here, so these highs up here from July or so of last year at, what is that, 219-ish or so. Let me put a straight line across. All right, so that's all-time highs. This is a name that is beneath all-time highs, has recovered well, like most names from the December low. The pullback after the weekly 9 setup count came right into the cloud. Oops. Bottom, and it's turned right back and made high. So, look, this is in the process of getting close to challenging all-time highs. If it breaks through to new ones, look for 236 or so as a target on the upside. Again, a place that if you're long the name or you want to sell calls against or something like that, that's not a bad place to do it. On the downside now, 181.5 or so is the key level that it needs to hold above on Friday closes. Notice too, there's a gap here, so this level actually becomes important. You may fill the gap, but not really break through this level with materially. So on the downside, if you long the name, you kind of want to be paying close attention to the 181 level. Okay, Berkshire Hathaway. One of the, again, biggest cap names there is on a weekly chart. So we're looking at all-time highs back here. Let me just change the scaling a bit, right? So look, this has moved up so much you can't even see the old price history. Notice what's happening. 13 up in here. Let's go back to an ellipse. All right, potential upside exhaustion. The 9 count here, potential upside exhaustion. We get a 13 count a few weeks ago, potential upside exhaustion. So everything here north of, let's say, anywhere from the 215 to 225 level for the last year and a half says when we get up there, we're getting these signals of upside exhaustion. Notice that the cloud has gone flat recently So I'm going to pay attention to this lagging line. If price, it's easy for price action to break through the cloud now because the cloud has hardly any width. What we want to pay attention is if we sell down enough that it pulls the lagging line through the bottom of the cloud. Now for the next few weeks, that goes all the way down to 195. But let's say start September or so, that level moves up quickly. It means like if we were to take out these lows here at 199 in September, then you've not only taken out this most recent low, but your lagging line would be through the cloud. And that would be a major warning signal that this could have a change of trend. I want to see just quickly, when was the last time did it have? Okay, so it did come out in 2015. Both price and the lagging line came out through the bottom. And the only thing that would have kept me, I might have sold some, but I would have never gone short, is that we were deep in account looking for a bottom. So downside exhaustion here, 13 and 9 count coming together at the beginning of 2016. So that's one of the things too, that when you get a cloud model break, sometimes you can temper how much selling you do if the marked sequential counts are close to exhaustion on the downside. But right now, look, there are clear signals here of upside exhaustion. We've gone nowhere for a year and a half. If it breaks out to the upside, look for 232 as a target. That's the propulsion target. Above there, if it kept going, 244. JP Morgan, same type thing. Lots of, and you're going to see this in the financials, lots of upside exhaustion signals. They almost all line up with peaks. This one, we can't call a peak yet. You can see if we move higher, 125 to 127.5 for targets, and then there's some targets much higher up here at 160. So this whole year and a half long consolidation period either leads to a whole nother leg higher or a breakdown. Where's the breakdown now? If the lagging line comes underneath 103 or so, I'd be cautious, and as long as that didn't line up with a setup 9 count, in that case, you would look for this to move lower. So again, I'm giving you levels above and beneath, but right now kind of getting caution signals as we have for a year and a half about getting long exposure. Google, I'm going to use Google GOOGL, because it's almost exactly the same as GOOG, so we're only going to look at one of them. This recently made a weekly 9 bottom after some exhaustion signals in here. And this is kind of, look, you're right in the middle of a trading range. There's no VIG to playing this name right now. You're smack in the middle of the range. There's a slight bullish bias because we're in a setup count towards the upside. The last 2 weeks, we're bouncing off the top of the cloud, so I'll give it a minor bull bias for an 1187 type target. Too early to call for this one up here. Ultimately, if we make new highs, 1346 would be the target. And on the downside, qualified and confirmed close on a Friday basis, you need 1091 would be my level that I'd have to watch out for on the downside. Sorry I didn't get to all the names, but at least I gave you a thorough look at the names that we did get through. In order to contact me, it's Rick at inthenotrader.com. Also check out our website, inthenotrader.com. Lots of videos on there. And of course, if you're looking to sign up to our weekly newsletter, that clearly looks at the market in a very different way than most other newsletters do, because this is designed to tell you how institutions trade, where and when they make their decisions. And we do that pretty darn well. That's it for this week. I'll be back in New York next week. Have a good trading week, and get yourselves ready for the Fed next week. Bye-bye.